Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results.
So stressful when the world's on fire. Good God. I can't look at this, guys. Like, my strategy is you buy it and you hope that you got a good spot. Yeah, but we all think you're crazy. You don't fight this. No way. The markets are freaking out and you don't think that anything is wrong? Come back tomorrow and I'll lose it all. Should be fun. Good afternoon, everybody. So we got about 4 or 5 minutes until the FOMC interest rate decision is released here. You know what? I need to turn on the lights here. It looks so ugly without the blue light. Oh my gosh. There we go. There we go. Some color in here. That's better. That looks better. And I got the thing. I realized I didn't have the board on this morning. So, anyways, it's kind of weird because there is a lot of volatility protection built up around this event. I mean, like, particularly high for a Federal Reserve meeting, but nobody seems to be expecting that the Fed is going to do anything surprising. So I don't know. One thing I am noting that I didn't note for you guys before, if you were here in the morning. Good morning, or afternoon, Imanu. Laser Eye. There's a few new names in. We believe, at least, we theorize that the Federal Reserve has a good idea of what the non-farms number is going to be able to factor it into the meeting. So there is going to be some people kind of trying to read for hints about that when he speaks. We're getting pinned. Yeah, well, people were doing stuff in ES, right, this morning. This is probably going to move no matter what. I was thinking, hey, if I could get a good price, they actually were giving us an okay price in the micro treasuries for a second, but I don't think it's worth the risk. This is probably going to be one of those like big wave things. So like, I think you'd probably want to wait. Like, if there's a move, wait for it to pull back all the way and even trace back the other way a little bit first, and then trying to take it out the other way. This is the same that we had it yesterday. Well, I'll just keep yapping here and let the number come out. But when the number comes out, I'll be quiet. And we'll just let it go here while it's all crazy, right? Let's make sure I got Financial Juice all set up here because I haven't heard them. Okay. We'll get the tweeters. 1 minute. There he is. I can hear him. Now I might do some sim trades. So, in fact, I tell you what. No. I want 4. We'll do a YOLO long trade in the S&P 500 on sim. No, don't go down. Now they're gonna stop me out. Boo. There's the pull. I'm going to try it multiple times here. Oh. Come on. Come on. There we go. Okay. Okay, so note that the taper is 60 billion a month. So I guess it was they're be doing 60, and that's a reduction of 10 billion. So I believe that that's in line with what they were expecting. Well, I got it right. I think that there's a little bit more in this. Both of those worked well. So I did get my fill on the second one. Oh, actually, I take that back. I canceled it. Hold on. There's a little bit more. There's a little bit more to go on that one. In the ES. But in the ZN, I was like, okay, I'm going to try and average into something here, and that worked out really well. So I should have gotten more off of my first contract, but that's okay. Dude, Lucas, my kids, they were like getting into mukbang, and I was like, heck no. They wanted to watch it on the TV. I want to put it on the TV and force everybody to listen to it. No, I don't want to watch that. This is gross. Hear that, rather. I mean, watching it is probably like whatever, but I'm like doing way too well in these positions for how casual I'm being about it. Yeah, so what happened was I put in a treasury one before it stopped out, unfortunately, but that was just kind of like as it came, so I ignored that one and got in again. When it came back, I said, well, okay, because of the way that these go, it's going to come back on us, but I'm pretty positive that the news that we've got was positive news that the market is going to read as dovish. So I tried averaging into this one over here, and I added a contract on the E-minis. I don't like the word predict, because when I was this morning, it was like, I don't know what's going to happen, right? There was a split second YOLO just before the news came out. So now the Treasury kind of going both ways here. There's something else going on. I'll do that one too. Yeah, adding there is a little bit risky, but I think that it's a little bit much to be asking for a huge sell in here at this spot. Let's come in here and see if I can find this statement. Let's see here. Supply and demand imbalances related to the pandemic and the reopening of the economy have contributed sizable price increases in some sectors. They got rid of, will likely continue to reduce the effects of the public health crisis on the economy, and an easing of supply constraints are expected to support continued gains in economic activity, as well as a reduction in inflation. In light of this potential further progress the economy has made towards the committee's goals since last December, the committee decided to begin reducing the monthly pace of its asset purchases by $10 billion for securities and $5 billion for mortgage-backed securities. Beginning later in the month, the committee will increase its holdings of this Treasury securities by $70 billion per month, and of agency-backed purchases by at least $35 billion. So they reduced the aggressiveness of the taper a little bit, right? Beginning in December, the committee will increase its holdings of Treasury securities by at least $60 billion per month, and of agency mortgage-backed securities by $30 billion per month. The committee judges that similar reductions in the pace of asset purchases will likely be appropriate each month, but it is prepared to adjust the pace of purchases if warranted by changes in the economic outlook. The Federal Reserve's ongoing... So we get to basically talk about, will they taper every month now, huh? Okay, cool. And that's basically all the changes. So the Treasury is kind of acting on both ways. So I could be like dead wrong on this. We'll see. So I really wonder what they were doing there when that seller that pushed it down there and everything. That looked like unwise behavior. It might have been somebody exiting though. Like they flashed a big order down there too, right? Like why would you do that in the liquidity hole? There was also, I'm just hearing over the news squawk, and I'm looking at it myself at the moment. Bitcoin did move on this. It took quite a hit initially. They've recovered it largely, but they dropped on this news. You got one in gold. I mean, the gold doesn't look like it's moved too much off of this, but. Apparently, they're pricing in pretty high chance that they raise rates in July. But that they're saying that right now kind of suggests to me that the market largely had it priced in. Okay, I guess we puke. That's okay. We scratch it. I'll be right back. I want more water. Okay, so let's try and sort out what's going on here in the Treasury. I think right now they're still in low liquidity mode. There is some liquidity at 16.5, and then an area where you would always expect to see some liquidity and that we can probably discount. I do see that once again we flattened with the 30-year not moving quite as dramatically as the 5-year and the 10-year. Oh no, wait, I'm looking at the cumulative delta there. The selling was more dramatic in the 30-year. Okay, so we are dropping there because of the 30-year, because we are steepening. That's what's going on here. We're steepening. Okay. So I'm going to try doing this again. I'm going to be a little bit more, I'm going to be a little less cavalier about it this time though. Okay, that was a good sign. Good. See you later. Okay, guys, so what do I mean by we are steepening? So what is happening is they are buying the 5-year treasury and they are selling the 30-year treasury. And so because we already had an initial move up, in order for them to put the spread trade on, they turned around and they started selling the 30. And when they started selling the 30, that pushed them all down. And that's why we had that retracement. And that's why I was kind of looking at like, oh, okay, I think I can, I puked, got water, come back. Actually, I can try and take it long here. But it was a little bit putting on less risk on it that time. And it looks like maybe now it's going to run away from us. So. But it means to me, when we saw that flow moving down, your immediate thought is, oh, is maybe either I missed something. Is this actually hawkish? No, it was the spread. Is what my take on that is. But they went really far. When they came down, they did. They did. Like when ZB sold there, it was really crazy aggressive. But the point is, I do not believe that the selling order flow that we saw in the treasury there was indicative of informed flow. I see people saying all this negative stuff about gold, but I feel like that gold is handling this pretty well. In fact, if this continues in the treasury, and I mean the treasury is going to have to come back up a lot because we're still down from where we started the day, right? But maybe gold could rally. Like I could see reasons to be getting into gold right now. What about the dollar? I don't really have the dollar up here. Let's put it over here. Oh, the dollar's just been all over the place. I think this should weaken the dollar a little bit. Like, they're probably not going to be able to hold 94 in the dollar index, right? Barring nothing crazy in the J-Pow speech, do you see ES bullish going to finish today? Yeah, I think there's probably still some options sitting out there that, given current trends continue, could provide more upside on the S&P 500. News snap analysis by News Squawk. Fed announced its USD 160 billion and 5 billion of QE tapering for U.S. Treasuries and mortgage-backed securities, respectively. As expected, has directed the desk for that pace for the next 2 months ahead and expects similar reductions to be appropriate each month, but it is prepared to adjust the pace if needed. The statement was largely otherwise changed, although interestingly, the Fed changed its description of inflationary as transitory to expected to be transitory. With that softening of language, perhaps laying the groundwork, at least providing optionality for the Fed to lean more hawkish, which lines up with its description of tapering as being at pace that can be changed if warranted. We now look to Powell Presser and Q&A, where the key talking points will be his opinion on rate hike pricing as soon as H2 the second half this year. Also, further to earlier points of Powell's, that should be, it says second half of next year, right? Also, further to the earlier points, if Powell stresses the flexibility of the taper process, walks back further on describing inflation as transitory, and discusses full employment being lower than previously anticipated, these would likely be construed as hawkish. Okay, so I think that they're right. The announcement was dovish. But the risks that we face now going into the press conference in 5 minutes are dovish. So since we're so close here, I am going to take off one of the contracts in MES. And that way, I give myself plenty of room. And I wish I could do that over here, but I'm just going to have to work with what we got over in the Treasury. And let me pull up the press conference. Hopefully that didn't go out over the stream because that was loud. Yeah, okay, we're good. This time I'm going to choose to cover up we can put it over here. Why not? Ain't nobody need to see the 2 year. Nobody needs to see the 2 and the 5 year. Nobody cares. Are they dovish? I mean, I think that the announcement was more dovish than expected, yes. Like the pace. So here's why I would say it's more dovish than expected. The pace of mortgage-backed security reductions is like $5 billion less than what they said in the last statement, and they kind of hedged a little bit on some of these things. So they're kind of giving themselves the language to say, well, we might change it. Like, we could increase or decrease the purchases next month and do a month by month is basically what they're saying. So overall, it's more dovish than anticipated. But I think what you're getting at, Lucas, is that we're still raising rates, right? Like the longer term the longer term thing here is rates are going to rise in the next 2 to 5 years, right? So that's where News Squawk was getting in there, that when we get into the press conference, there are some things that Powell could be speaking about that could be hawkish. For instance, he could say, well, we're starting to become a little bit more concerned that it's not transitory. That's why we changed the statement. You know, that sort of a thing. So there could be hawkish order flow come throughout the press conference. Do you think they should be dovish? I don't think so. I think that the current Federal Reserve policy is about appropriate. So this thing right here, they've got, they probably should be climbing back up, but they can't. They can't because they're just stuck. It needs to wait a little bit. So I'm glad that's why I'm like, I wish that I had caught the other contract. I could be taking it off here. I think that the being slightly more dovish than anticipated was probably the right call, yeah. Like, I think that the interest rates have gotten to a spot where they should be. 1.6. I think that's what it should be right now. Well, this time I think what I'm going to do is I'm going to take that off and see if they come back into me. Yeah, well, it is really low, but can't raise it all at once. Yeah, I don't like the Austrian school. I don't think that I've appropriately expressed my opinion of the Austrian School of Economics. I feel that the Austrian School of Economics has become popular on the internet lately as a way to be contrarian, because some people don't like the current interest rate policy, and they think that the Austrian School of Economics would suggest a change. But I really don't feel that the Austrian School of Economics has made any kind of strides or breakthroughs that would justify giving them any attention right now. And I don't really see the empirical evidence to suggest that their way of looking at economics would be more effective.
The FOMC kept interest rates near zero, and in light of the progress the economy has made toward our goals, decided to begin reducing the pace of asset purchases. With these actions, monetary policy will continue to provide strong support to the economic recovery. Given the unprecedented nature of the disruptions related to the pandemic and the reopening of the economy, we remain attentive to risks and will ensure that our policy is well positioned to address the full range of plausible economic outcomes. I will say more about our monetary policy decisions after reviewing recent economic developments. Economic activity expanded at a 6.5% pace in the first half of the year, reflecting progress on vaccinations, the reopening of the economy, and strong policy support. In the third quarter, real GDP growth slowed notably from this rapid pace. The summer's surge in COVID cases
well, I don't like the way it's moving
in
the Treasury now,
in the
so
sectors
cancel
most
my order.
adversely affected by the pandemic, including travel and leisure. Activity has also been restrained by supply constraints and bottlenecks, notably in the motor vehicle industry. As a result, both household spending and business investment flattened out last quarter. Nonetheless, aggregate demand has been very strong this year, buoyed by fiscal and monetary policy support and the healthy financial positions of households and businesses. With COVID case counts receding further and progress on vaccinations, economic growth should pick up this quarter, resulting in strong growth for the year as a whole. Conditions in the labor market have continued to improve, and demand for workers remains very strong. As with overall economic activity, the pace of improvement slowed with the rise in COVID cases. In August and September, job gains averaged 280,000 per month.
But are they
down
going to
from
smash
an
into
average
the
of about 1 million
16?
jobs per month in June and July. The slowdown has been concentrated in sectors most sensitive to the pandemic, including leisure and hospitality and education. The unemployment rate was 4.8% in September. This figure understates the shortfall in employment, particularly as participation in the labor market remains subdued. Some of the softness in participation likely reflects the aging of the population
so they took
and
16
retirements.
half.
But participation for prime-aged
There's
individuals
16.
also remains well below pre-pandemic levels. In part,
Now,
reflecting
interestingly
factors
enough, I'm
related to the
seeing more
pandemic,
activity
such
in
as
the
caregiving
5 and
needs
10.
and ongoing concerns about the virus. As a result, employers are having difficulties filling job openings. These impediments to labor supply should diminish with further progress on containing the virus, supporting gains in employment and economic activity.
Cool.
The economic downturn has not fallen equally on all Americans, and those least able to shoulder the burden have been hardest hit. Despite progress, joblessness continues to fall disproportionately on African Americans and Hispanics. The supply and demand imbalances
They absorbed
related
a
to the
lot of
pandemic
contracts
and
down
the
there at
reopening
16.
of the economy have contributed to sizable price increases in some sectors. In particular, bottlenecks and supply chain disruptions are limiting how quickly production can respond to the rebound in demand in the near term. As a result, overall inflation is running well above our 2% longer run goal. Supply constraints have been larger and longer lasting than anticipated. Nonetheless, it remains the case that the drivers of higher inflation have been predominantly connected to the dislocations caused by the pandemic, specifically the effects on supply and demand from the shutdown, the uneven reopening, and the ongoing effects of the virus itself. We understand the difficulties that high inflation
I wouldn't be surprised
poses
if we
for
come in and we
individuals
look back at
families,
that and we
particularly
go,
those with
man,
limited
whoever
means to absorb
sold down
higher
there at the
prices
bottom got had.
for essentials such as food and transportation.
That was awfully suspicious
Our
the way
tools
that played
cannot
out.
ease supply constraints. Like most forecasters, we continue to believe
That
our
they
dynamic
hit into
economy
8K
will adjust
icebergs and
to
then
the supply and
immediately
demand
they
imbalances,
back up
and
6
that as
ticks
it
again.
does, inflation will decline to levels much closer to our 2% longer run goal. Of course, it is very difficult to predict the persistence of supply constraints or their effects on inflation. Global supply chains are complex. They will return to normal function, but the timing of that is highly uncertain. We are committed to our longer run goal of 2% inflation and to having longer term inflation expectations well anchored at this goal. If we were to see signs that the path of inflation, or longer term inflation expectations, was moving materially and persistently beyond levels consistent with our goal, we would use our tools to preserve price stability. We will be watching carefully to see whether the economy is evolving in line with expectations. The Fed's policy actions have been guided by our mandate to promote maximum employment and stable prices for the American people, along with our responsibilities to promote the stability of the financial system. Our asset purchases have been a critical tool. They helped preserve financial stability early in the pandemic, and since then have helped foster smooth market functioning and accommodative financial conditions to support the economy. Last December, the committee stated its intention to continue asset purchases at a pace of at least $120 billion per month until substantial further progress has been made toward our maximum employment and price stability goals. At today's meeting, the committee judged that the economy has met this test and decided to begin reducing the pace of its asset purchases. Beginning later this month, we will reduce the monthly pace of our net asset purchases by $10 billion for Treasury securities and $5 billion for agency mortgage-backed securities. We also announced another reduction of this size in the monthly purchase pace starting in mid-December, since that month's purchase schedule will be released by the
Didn't
Federal
this guy
Reserve
make
Bank
a
of New York prior
$1.7
to
million
our December
trade? We're
FOMC
talking
meeting.
about Powell here?
If the economy evolves
I
broadly as
didn't
expected,
really.
we judge that similar
I think
reductions
they
in the
kind
pace
of
net asset
misrepresented
purchases will likely be
that.
appropriate each month, implying that
What's
increases
going
in our
on is
securities
they're
holdings
taking
would
things
cease
that
by the middle
Federal
of next
Reserve
year.
members do all the time, and
That
it's
said,
pretty
we are
standard
prepared to adjust
run-of-the-mill
the pace of
stuff,
purchases if
and
warranted by
trying
changes
to make a
in the
big deal out
economic
of it in the
outlook.
media in the hopes that they can
And even
get
after
more
our balance sheet
progressive
stops expanding, our holdings of
Federal Reserve Board.
securities will continue to support accommodative financial conditions. Our decision today to begin tapering our asset purchases does not imply any direct signal regarding our interest rate policy. We continue to articulate a different and more stringent test for the economic conditions that would need to be met before raising the federal funds rate. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to complete the recovery in employment and achieve our price stability goal. Thank you. I look forward to your questions.
Thank you. We'll go to Nick at the Wall Street Journal.
Hi, Nick Timmeros of the Wall Street Journal.
Jigsaw's
Chair
being a little
Powell,
slow
the
there.
markets anticipate you will
Cool.
raise rates once or twice next year.
Lucas, yeah,
Are they
they
wrong?
want they want to get rid of Powell, and they want a Federal Reserve that will promote
So,
racial justice
say
or
it this
whatever
way.
you call it, social justice.
we try to focus on what we can control, and that is how to communicate as clearly as possible in this highly uncertain world how we're thinking about the economic outlook and the balance of risks, and how policy will evolve in that case, and also in the cases which are frequent where the economy evolves in unexpected
Never mind.
ways. So the
I was
focus at this
slow on the
meeting
draw
is
on that one.
tapering asset purchases, not on raising rates. It is time to taper, we think, because the economy has achieved substantial further progress toward our goals, measured from last December. We don't think it's time yet to raise interest rates. There is
Oil's
still ground
tanking
to cover to
right
reach,
now. What's with that?
maximum employment, both in terms of employment and in terms of participation. Getting to your question, our baseline expectation is that supply bottlenecks and shortages will persist well into next year, and elevated inflation as well, and that as the pandemic subsides, supply chain bottlenecks will abate and job growth will move back up. And as that happens, inflation will decline.
We're kind of in an
from
area where
today's
we could just
elevated
slosh
levels. Of course,
around.
the timing of that is highly uncertain, but certainly we should see inflation moving down.
Still
by the
seeing
second
the
or third
weak,
quarter.
the
Time for lifting rates
liquidity
and beginning
is.
to remove accommodation will depend on the path of the economy. We think we can be patient.
We could have fun
if,
here.
If a response is called for, we will not hesitate. So what I will tell you is we're watching carefully to see whether the economy evolves in line with our expectations, and policy will adapt appropriately. And that's what I would say.
Well, based on, if I could follow up, based on your current outlook for the labor market, do you think it's possible or likely even that maximum employment could be achieved by the second half of next year?
So if you look at the progress that we've made over the course of the last year, if that pace were to continue, then the answer would be yes. I do think that that is possible. Of course, we measure maximum employment based on a wide range of figures, but it's certainly within the realm of possibility.
Thank you.
Thank you. Next, we'll go to Gina at the New York Times.
Armin, I really don't feel
Chair
that
Powell.
your
I was wondering if you could detail a little bit
synopsis of what happened is very
at
accurate.
This moment. Obviously, we're seeing strong wage growth, particularly for people in sort of lower income fields.
Now is probably
I
not
wonder
the
if you
time
see
to
that as a
argue about it, though.
positive thing Or as a potential start to a wage price spiral, and sort of how
That's
you sort of
Powell. We
delineate
can be
those two
patient,
things.
says First Squawk, is
So
how they read that one.
Wages have been moving up strongly, very strongly. And in particular, I would point to the Employment Compensation Index reading that we got last Friday. Now, in real terms, they had been running a little bit below inflation, so real wages were not really increasing. I think with the ECI reading, it becomes close to maybe not increasing, but close to back to zero in terms of the real increase. So Wages moving up, of course, is how standard of living increases over the years for generation upon generation. It's very important, and it's generally a good thing. The concern is a somewhat unusual case where if wages were to be rising persistently and materially above inflation and productivity gains, that could put upward pressure on or downward pressure on margins and cause companies to their employers really to raise prices as a result. And you can find yourself in what we used to call a wage price spiral. We don't have evidence of that yet. Productivity has been very high. The ECI reading is just one reading. Again, if you look back,
I've been getting really good feels
so
today.
We'll be watching this carefully, but I would say that at this point we don't see troubling increases in wages, and we don't expect those to
Probably could
emerge,
have
but we'll be
moved
watching
that
carefully.
one. It's okay.
Next, we'll go to Steve Leisman from CNBC.
Thank you, Mr. Chairman. I wonder if you could perhaps give us your thinking about the trade-offs between inflation and unemployment. You've talked about the shortfall in unemployment or employment relative to before the pandemic, and yet you have inflation, which is affecting everybody. Are we at or close to a point where the risk of inflation is greater than the benefit that you'd for recovering these lost jobs, so that now from a risk management standpoint, it makes sense to move more aggressively on rate hikes? And kind of a related question, the statement today says you'll keep policy accommodative until you hit that 2% inflation target. Our surveys show looking for 5% inflation this year, 3.5% next year. It sure seems like you're on track to modestly or moderately exceed that 2% target. Thanks.
Yeah, so I'm not sure I totally got your first question, but I would say, in fact, could you just quickly, succinctly say your first question again?
Sure. The idea that the trade-off between inflation and unemployment, that you would keep policy accommodative to put this 5 million folks or find these 5 million jobs again. At the same time, all Americans will be suffering from higher inflation. Is that trade-off worth it, or is it better or smarter to raise rates right now to combat inflation and perhaps not lean so heavily on the employment side of the mandate?
Yeah, so this isn't the traditional Phillips curve situation where there's a direct trade-off, where that's really what we're talking about. The inflation that we're seeing is really not due to a tight labor market. It's due to bottlenecks, and it's due to shortages, and it's due to very strong demand.
That's a way better way of saying it than saying that it's transitory. You should say that it's inflation is not due to the tightness in the labor market.
But in this situation, we do have a provision in our statement on longer run goals,
which is accurate.
That says
at least right now it's accurate.
What we do.
I think that the problem is that it could very, very easily go into inflation in the labor market.
And the potentially different time horizons over which employment and inflation are projected to return to levels judged consistent with the mandate. So we used to call that the balanced approach paragraph. We have to think about the amount of the deviation. We have to think about the time it will take. And we have to make policy in a world where the two goals are in tension. It's very difficult. But what it really boils down to is something that's common sense, and that is risk management. We have to be aware of the risks particularly now the risk of significantly higher inflation. We see shortages and bottlenecks persisting into next year. We see higher inflation persisting, and we have to be in position to address that risk should it become really a threat should it create a threat of more persistent longer-term inflation. And that's what we think our policy is doing now. It's putting us in a position to be able to address the range of plausible outcomes.
Yeah, that entry ended up working out really well, didn't it?
Financial Times.
I was trying to build a position down in here, and I had given up on it, but I really should have gone along with it.
What are the economic conditions that would perhaps
if you come over here and look at my stats, this is all sim, of course.
And I'm wondering how you
this is the E-mini trade. That's the one that stopped out.
Actually need to accelerate
that I didn't really feel was very fair, but whatever.
So I guess as I said in my
but look at what I've done since then. Now these two, they ran, and I should have taken making more profits on them, but
the committee judges
I've
that
been
similar
playing it
reductions
really
in the
well.
pace of net asset purchases will likely
Sometimes
be
when it starts
appropriate each
moving
month,
like this,
and we're
your
prepared
read
to
on the
deviate
DOM
from
can
that
be
path,
really effective.
if warranted by changes in the economic outlook. So I'm not going to give you a lot more detail on what that
So
might
that they
be.
just
Of course,
kind
if
of
we
show
do
you
see
where
something like that happen,
where they're
it
going to hold a
becomes
knot,
question,
and
we'll
because there's not a
communicate
ton
very
of liquidity
transparently
on there and
openly
everything, it's
about that. But I'm just going to leave it with the words.
they
that are in the
don't
statement.
surprise you
So
as
was there a
much.
second part?
Yeah, it's just on characterizing the risks that you might actually have to do so later on.
You know, I would just leave you with the words we have here. We are prepared to speed up or slow down the pace of reductions in asset purchases if it's warranted by changes in the economic outlook. And again, if we feel like something like that's happening, then we'll be very transparent.
So Fed
We wouldn't
always
wanna
behind the
surprise
curve,
markets.
probably.
We'll say in light of this factor or these factors, we are considering doing this, and then we would either do it or not do it. But but I'm not going to start making up examples.
Would you rather
of what that
them
might be
use
today. Thanks.
empirical data that we can all watch and analyze ourselves and
That's what
make a
Rachel
data-based
Siegel of the Washington
approach
Post.
and be late, or would you rather them be
Hi, Chair Powell.
speculative
Thank you so much for
and
taking our
try and be ahead of
questions.
it, but then
You
get it
mentioned
dead
at the
wrong?
beginning that the Fed understands the difficulties that high inflation poses for individuals and families, especially those
Nah,
with
that's
limited
not true.
means.
They don't create the
But
problems
what
they're
was your
trying to
message
solve.
to
They
those
didn't
families
create
or
the
consumers
pandemic.
that are struggling with higher prices right now? And do you feel that your expectations around transitory inflation that message is reaching them? Thank you.
Yeah. So. First of all, it is our job to, and we accept responsibility and accountability for inflation in the medium term. We're accountable to Congress and to the American people for maximum employment and price stability. The level of inflation we have right now is not at all consistent with price stability. By the way, we're also not at maximum employment, as I mentioned. So I would want to assure people that we will use our tools as appropriate to get inflation under control.
I'm surprised they're still leaning on COVID as a future problem. I am surprised that it's still in this statement, but
that will happen as the Delta variant.
I wouldn't characterize it as a leaning on
declines.
COVID.
So, which it's doing now. As I mentioned, so
but the thing is we still got the winter
is a word
to deal
that,
with.
People have had different understandings of. For some, it carries a sense of short-lived. And that's there's a real time component measured in months, or let's say. Really, for us, what transitory has meant is that if something is transitory, it will not leave behind it permanently or very persistently higher inflation. So that's why we took a step back from transitory. We said expected to be transitory. First of all, to show.
Okay, I got my target.
We've always said that, by the way, in other
I think
contexts.
maybe I should have that one and just let it run all day, but I wanted to test out
people, and then we added some
16 points
to really explain more what we're talking about in paragraph 2 and paragraph 3.
I was speaking to a trader the other day, and they said that they were using span margins to determine their targets, and that they had come up with 16 points. And I was like, well, that's not how far it's been going. I'm going to try it.
Continued gains in economic activity and employment, as well as a reduction
and it worked pretty okay.
in inflation. So
maybe they go a lot further, though.
Explain what we mean. And also acknowledging more uncertainty about transitory. So it's become a word that's attracted a lot of attention that maybe is distracting from our message, which we want to be as clear as possible. Ultimately, the only other thing I would say is, look, we understand completely that it's particularly people who are living paycheck to paycheck or seeing higher grocery costs, higher gasoline costs. When the winter comes, higher heating costs for their homes. We understand completely what they're going through, and we will use our tools over time to make sure that doesn't become a permanent feature of life.
Let's reset
really,
this.
that's one of our principal jobs, along with achieving maximum employment, and that's our commitment.
Thank you. We'll go to Chris Rugaber of the Associated Press.
Great. Thank you, Michelle. Thank you, Chair Powell. Well, I wonder if you could update us. You talked about getting back to full employment. And so could you update how you define that? I mean, a few months ago, yourself and other Fed officials talked about getting back to the pre-COVID labor market. There was even hints that might try to do something better than that. Now
well, what was? Well, I didn't look at the VIX range. What was the VIX one?
Talk of not being able to get back. Is all the jobs back because of that and other trends? You did mention
in this kind of a situation, I think that you could totally.
Examples of things you're looking at specifically to measure full employment.
I don't think it's crazy to try and go for the 64.
And if so, do you need to see that get back to pre-COVID levels?
Yeah, 16 points, 4 points per tick.
Achieve maximum employment?
Here, I'll show you again. These are sim. I don't want anybody to ever come back and be like, "Oh, Seth, you lied to us." So I want to be really clear, like what I'm doing, and not every trade that I take is live. Okay. But here's all of the sim orders that I did today.
So
so these were all. These first three were in the morning. That one was actually a mistake. That one was a legitimate loser. That one was a mistake.
But in addition, there are other
but then I got that one.
Of what's going on.
Then this was the one that stopped out on the open.
A key measure of how tight the labor market is.
This one, I don't remember why I lost 1 point. I think that one was also a mistake. Like I put it in and I didn't have the right stop set, and so it immediately stopped out.
And you make an overall judgment.
Then,
now,
but you also know I let these two right here, I made a lot on, and I let them come back on me a lot. So if I had kept this original trade and had been better at taking the sequential profits and adding when it came back in here, this could have been up to like $500 by now, right?
We have to be humble about what we know
it's not
about
perfect.
This economy, which is still very
but I'm doing something where
COVID affected.
I'm taking on a high degree of risk, right?
This is because of Delta.
Taking on a high degree of risk by placing orders in when the queue is light.
And we see these things. But so I think we're going to have to, ideally we would see further development of the labor market in a context where there isn't another COVID spike. And then we would be able to see, I think, a lot. We would see how does participation react in that world, in that sort of post-COVID world. Right now, people are staying out of the labor market because of caretaking, because of fear of COVID to significant extent. We thought that that schools reopening and elapsing unemployment benefits would produce some sort of additional labor supply. That doesn't seem to have been the case, interestingly. So I think there's room for a whole lot of humility here as we try to think about what maximum employment would be. We're going to have to see some time post-COVID so that we know, or post-Delta anyway, to see what is possible. And I think the learning for those of us who lived through the last cycle is that over time, you can get to places that didn't
seeing the dollar decline now as the treasuries have moved up here, by the way.
We have high inflation, so we have a completely different situation.
Bitcoin is moving higher
inflation, and we have to
after the initial down move off of the news
in the employment market. So it's a complicated situation, and I would say we hope to achieve significantly greater clarity about where this economy is going and what the characteristics of the post-pandemic economy are over the first half of next year.
Thanks. We'll go to Howard Schneider at Reuters.
Thanks, and thanks for doing this. So given that answer about employment, I would like to get back to Steve's question a little bit. On a headline basis,
screen probably looks like we're having a big earthquake, but my leg is really bouncing now.
Sorry, the two tests?
The two tests in the statement, the guidance.
Might be ticks. They came back there a little bit there, didn't they?
For 2%. Has the economy cleared that?
That's a decision for the committee. I would put it to you this way: when we reach maximum employment, when we reach
I'm doing good with 16 points on ES. Yeah, that one on ES that worked really, but that was just like that was just like YOLO long, right?
We're aware that language sounds a little out of touch with what's going on, but. We're not at maximum.
I don't know if I should pat my. I'm really proud of what I've done here in the Treasury
we'll look to see
today.
The inflation
what I did on the ES, that was luck.
There's a good chance that it will be if you look at how inflation has evolved in the last year.
It was luck. It really was.
So to follow up,
I really said this is going to be dovish. Maybe it wasn't luck.
And their persistence
the degree to which luck it was played,
So
I did make a prediction. I said I think that the S&P 500 is going to jump up after the FOMC, and I went long right before we came in, and
what I'm really saying,
I got stopped out, and I said, nah, that one doesn't count. I'll get in again, and then
we had the question on when the table,
after that, just luck, I say.
Speed of it and all that. We have not focused on whether we meet the liftoff test because we don't meet the liftoff test.
This is one over here in the Treasury.
What I'm saying is,
I've been managing it. I've been watching it. I've been catching them.
Let's say we do meet the maximum employment test. Then the question for the committee at that time will be, has the inflation test been met? And I don't want to get ahead of the committee on that, but the answer may very well be yes, it's been met. But we're not asking that question today because we're not running the liftoff test. We're not evaluating the liftoff test today. We didn't have that discussion.
So if you call it FOMC stayed the course, and yes, right,
the
yeah.
development of the economy, but we didn't ask.
I did say that they weren't going to surprise, huh?
Because
but you know what, that was
on the maximum employment side.
Why do I keep trying to be? You guys are all like, "Oh, Seth, you're the best," and I'm like, "Well, I'm not the best. I don't know how to take a compliment." You're right. I made some good calls today.
Bloomberg.
But on that one, I don't think that anybody was expecting them to surprise.
Economy is at maximum employment.
Just kind of like made trading it really difficult, didn't it?
What inflation is doing, and if not, does it kind of complicate that assessment given all of the uncertainty about inflation right now and the inclination to believe?
Well, but Lucas, what do you think about what he had just said there, though, where he was saying, well, we thought that when kids went back to school and the unemployment benefits ran out and stuff, that would increase labor supply, and it didn't.
We actually define maximum employment as...
How do we sort that one out?
We define it in terms of inflation, but of course there is a connection there. Maximum employment has to be a level that is consistent with stable prices. But that's not really how we think about it. We think about maximum employment as looking at a broad range of things. You can't just look at, unlike inflation, where you can have a number. But with maximum employment, you could be in a situation hypothetically where
I got out on my
the unemployment
Treasury
rate is low, but there are many people who are out of the labor force and will come back in, and so you wouldn't really be at maximum employment because there's this group that isn't counted as unemployed. So we look at a range of things, and
too many people making money from trading. Maybe
measures. We are at a very tight labor market. I mentioned quits and
wait, here, let me
job openings and wages.
Mute him for a second. I'm willing to sit down and say, like, yeah, paying people to stay home, that created the tightness in the labor market, or the lack of labor supply, let's say. Okay, but now that we have gotten rid of all of those things and we're not getting the labor supply, what do you have to do to make it happen? Because you have to say either one, that it just has nothing to do with that, or two, that you need a different policy, right? I kind of suspect, though, that it might not have anything to do with that. I kind of suspect that it may just be that people have kind of changed their perspectives on work and want more from their employers.
Process for balancing those two goals would be in the event that, say, come next year, you decide there's a serious risk of
it's showing some
ongoing employment shortfalls.
Yeah,
it's showing some signs of
I can't reduce
liquidity
it to
problems around the 24.5 area,
it's about risk management.
right,
so
where the VWAP is.
You want to be in a position to act to cover the full range of plausible outcomes, not just the base case. And in this case, the risk is skewed. For now,
yeah, a lot of high-level management jobs are working from home.
So we need to be in a position to act in case it becomes necessary to do so or appropriate to do so, and we think we will be. So that's how we're thinking about it. And I think, though, that judgmentally, too, it's appropriate to be patient. It's appropriate for us to see what the labor market and what the economy look like when they heal further. We know that we were on a path to a different place, as I mentioned, when Delta arrived, and Delta stopped job creation. It stopped that transition away from a goods-focused economy where there's excess demand for goods because their services are not available, people are not traveling. that transition itself.
But it's a two-pronged question, right? One, how do you prove it? Two, how do you fix the current problem?
While they start spending,
because they're not doing the unemployment anymore, right?
All sorts of travel services and things like that. So that we want to see that healthy process unfold as we decide what the true state of the economy
I got
is.
that
So
exit really well.
in a way that will mean
Did you see that?
lower inflation. Bottlenecks should be abating. We start to see that now.
On that one,
but overall,
I'm not even 100% sure how I can tell.
So that's really
to me. I feel like I'm just getting lucky over and over again. But I've done it enough times here in this flow that
if we do
it can't just be luck.
That it's necessary to do so, then we'll be patient, but we won't hesitate.
How did I do that?
Thank you. Let's go to Edward Lawrence at Fox Business.
Thank you, Mr. Chairman, for taking the call.
There is some data out there, Gus, about how many people opened trading accounts and stuff. Like especially in Robinhood, because they could go in and they looked at how many people opened up an account that was like in a multiple of the stimulus.
Is this putting us on the path to regulate what banks
Lucas says just a good entry.
Invest in? Like whole plans
the entry was okay.
So that's not a decision for bank regulators or for any.
Tell you what, when you get it to run a little bit, it makes life a lot easier, doesn't it?
We feel that any role
there's
that we
the GU ebb and flow.
have
That's what Grady would say.
Change. It relates to our existing mandates, and our existing mandates are really prudential regulation.
I feel that when the order book becomes really thin like this, that order flow,
to understand and be in a position to manage
exclusively order flow signals seem to work better.
Transition risks for climate, and by the way, the large financial institutions are doing this already, and we think that's right within our mandate. There's also a financial stability question, the overall stability of the financial system. And so from that standpoint, we can do research. We can
whatever you do, just don't put more than 600 in your bank account, dude. You're right.
Climate change affects the economy, both physical risk and transition risk. That's what we can do.
Well, I think what he's saying, Gus, is that like I'll mute him again. What he's kind of saying is that there is like a tempo to it. That so think about it in the context of the large meta orders again, right? When we have a large meta order, there's a certain distance that it can go before they start to run into the impact, the impact of the meta order decreasing and the damage that they've done to the order book, and they get stuck. And then they're going to wait a certain amount of time for the order book to recover, and then they might do another wave of the meta order, right? Well, when the market is really thin and we're moving like this, you're kind of seeing that sort of thing happen all over the place over and over again. And so you somehow, we as people or a neural network can kind of get a feel for it and know that when I get up there at 24.5, I'm seeing a decent amount of volume and there's a strong tick down, that's probably a sign that it's about time for me to get out, just because I know what the tempo has been. Two-way business is what it is, yeah. And like I said, when the market is thin and a lot of the because this is a lot of just us. A lot of this is just speculators trading here in this kind of action, right? So in that kind of there are times where your order flow reads just become really, really good. Like, and for me, it's usually when the book gets light. Like when there was that volatility crisis in 2018 in February, when the VIX like spiked super high and all those guys that were shorting the VIX got screwed. That was some of the best trading I ever did, and I just took a lot of little small scalps like what I was doing here. And it's like you can't lose. I don't know how to explain it, but it's just like you just get in the zone. You get in the zone and the order flow tells you exactly what's going to happen, and I can't even explain how I know. But it's not like that all the time, right? Rare when it's like that.
I asked the Inspector General to look to see whether there were rules broken and whether there were laws broken. And I won't speculate on that, but that is with the Inspector General now, and of course, out of my hands.
Thank you. We'll go to Mike McKee at Bloomberg.
Now I'm thinking about the micros over here, and I'm like, well, we could have gone.
Chairman,
I think I wanted to go long at 615, right? But we're actually still above that, believe it or not.
Monetary policy works, that you are likely to end up, given inflation, by having to raise rates faster and farther than you would have liked, and therefore send the economy into recession. Given the fact that basically your forecast has been chasing inflation over the last year, and now you're talking about it not coming down till the second or third quarter, why would they be wrong in thinking that?
Well, so let me say what's happened.
This is a question that I feel like you shouldn't have to think about, and it bothers me that he has to think about it.
Is that inflation has come in higher than expected, and bottlenecks have been more persistent and more prevalent. We see that just like everybody else does, and we see that they're now on track to persist well into next year. That was not expected by us, not expected by other macro forecasters. Now, let me say, it's difficult enough to just forecast the economy in normal times. When you're talking about, global supply chains in turmoil, it's a whole different thing. And you're talking about a pandemic that's holding people out of the labor force for reasons that we can sample, but we don't have a lot of experience with this. So it's very, very difficult to forecast and not easy to set policy. So we have to set policy, though. So that's what we're doing. And, so to look at your question this way, I don't think that we're behind the curve. I actually believe that policy is well positioned to address the range of plausible outcomes. And that's what we need to do. I do think it would be premature to raise rates.
There you go. There's his response to you guys earlier, right? I don't think we're behind the curve. I think we're well positioned to handle the range of risks that are out there right now.
There's still ground to cover to get to maximum employment, and we don't want to stop that when there's good reason to think. There's still good reason to think, although it's
average person out there, they want to say, this is what I think is going to happen. And they want to just make a big boom, this is what's going to happen. I'll make my big bet. And they want the Federal Reserve to do that. And they have to be more responsible than that, right? They have to acknowledge that their ability to forecast is really limited and that they're going to have to be able to handle a number of different things that could happen. There's a situation where inflation does get out of control. And there's a situation where it ends up not being a big deal, right? And there's a situation where things become deflationary again, and they have to give themselves the room to be able to act in all of those different scenarios.
Vaccine faster than certainly than I expected, and I think this stuff will work itself out over the course of next year. That is my baseline understanding, and that's very widely held among people. But we are prepared for different eventualities, and we will use our tools to achieve price stability and maximum employment. And we're going to let the data lead us to where we need to go. Our policy will adapt, and has already adapted, to the changing understanding of inflation and of bottlenecks and the whole supply side story, which is also partly a demand story. So our policy will continue to adapt as is appropriate.
Thank you. Let's go to Nancy Marshall-Genzer at Marketplace.
Hi, Chair Powell. Thanks for taking our questions. So you announced that the Fed is going to taper at a rate of starting at $15 billion.
Why would deflationary be bad?
Twice the pace of the last taper. So why are you?
Why would you want 2% and not zero? Okay, so if we had zero inflation, that wouldn't be bad.
I guess it was 2013. We were much farther away.
Why they chose 2% is actually a really interesting topic. And the answer to it, I think, is not very good.
Very, very strong.
It could be they could do zero.
And job openings substantially exceed
but negative is very bad for the economy.
Employed people. So the need for further stimulus is far less than it was in 2013, where we still had quite a ways to go. I mean, after we began that taper, it was still many years before we reached what I would characterize as conditions consistent with maximum employment, let alone price stability. So this is quite a different situation, and the committee unanimously felt today that we had met the test that we'd articulated, and this was appropriate. And this is faster than what people had expected 6 months ago. It's earlier and faster, And that's because as I mentioned, our policy has been adapting to the situation as it evolves, as it's clarifying itself. And that's partly because we see inflation coming in higher. So.
Thank you. Let's go to Mike Derby.
Yeah, thank you for taking my question. I wonder if the Fed has given any thoughts yet to the end game for the balance sheet in terms of, once you get the taper process complete,
the 30-year
will
has
you hold
come
the balance
almost all the
sheet
way back
steady,
again.
or will you allow it to start passively
So are we getting
winding down?
steepening
And then in
again?
a related question, do you have any greater insight into what Fed bond buying actually does for the economy in terms of its economic
You know what?
impact?
I should pull up my
Have you been
stocks
able
because
to, measure it or quantify
although I'm
it
sure
in
it's going to
any
look ugly
fashion?
because of Zoom. Or
I'm sure,
sorry,
there's often been questions
Zillow.
about what is bond buying actually
Some
doing
of
to
my
help
other
the
plays
economy.
might have been
Sure. So in
benefiting
terms
from
of the
this.
balance sheet, those
Let's see.
questions that you mentioned, we
Or
haven't
the
gone back
list,
to
my
them.
watch list.
Now that we've tapered, I expect that that's exactly what we'll do in coming meetings, and we'll do it in an orderly fashion. And we'll talk about reinvestment and all those things. And we don't have to make decisions on those yet. But typically when we're doing a new subject like that, we'll have a series of briefings and discussions, and that's what we will now begin to do. In terms of the effect of asset purchases on the economy,
Zillow has just been dismal today.
Tremendous amount
down
of
another
research and scholarship on this.
24%. That's
And,
so ugly.
You can kind of you can
But
find
Sumo
different
Logic
people
is
coming out with
benefiting a
different
little
views,
bit,
but I would say
and
most
GS is
mainstream
not.
view
So
would
that's
be that
interesting.
You're at the effective lower bound.
So got a
So
big
how do
move
you
on
affect longer-term rates? There are two ways.
rare earth
One,
resources.
So you can't
Let's
lower
look at
rates.
some of these
let's say
other
you can't
ones.
lower rates any further,
Amazon.
hypothetically. So you can give
AMC
forward
is
guidance.
doing
You can
well.
say
So
we're going to
the
keep the rate
and
rates
Bed Bath and
low
Beyond,
for
of
a
course, we
period
already
of time,
talked
either a
about that.
specific period until certain
Kind of looks like
conditions are met.
the short,
The markets will do the math,
short
and that'll have an
covering
effect
plays
on
are doing
longer-term
well.
borrowings, even 10, 30 years out, kind of thing. So that's one thing. The other thing you can do is you just go buy those securities, buy longer-term securities. That will drive down longer-term rates and hold them lower. And rates right across the rate spectrum matter for borrowers. So lower rates encourage more borrowing, encourage more economic activity. People that you can service your debt, you have more free cash flow. It's not different from what we do at the short end. So that was discussed long before anybody did it. That was, I think, Milton Friedman said that was what you could do if you were pinned at the lower bound many, many years ago. So anyway, that's how it's supposed to work. And it's quite hard to be precise about these things because you only have one economy and you can't run two different economies.
Get the real estate moving? Well, but they got the real estate moving and it went too far, right? That's why I'm so screwed in Zillow right now. I should have just sold it on the open.
Which is to say, at the margin, more economic activity.
It's okay. Me and Kathy Woods, we can feel the pain together.
More financial conditions lead to more economic activity over time with a lag. So
that put me
I
at,
think
by the way.
That's the main finding I would say
It hurts.
on QE.
Thank you.
Thank you. We're going to go to Paul LaMonica at CNN.
Chair Powell, you've addressed already questions about the stock purchases that took place from some of the regional Fed presidents, and
so we should pay attention to this.
To make sure that they.
So you're going to have a
trust the
prepared
Fed.
statement on
I
this?
was wondering also, in light of the fact that we now have questions about your own future, whether or not President Biden will nominate you for a second term, what would you say to the president and to senators that potentially will be voting on a renomination about this specifically?
Hey, thanks for stopping by, Lucas.
To your future as Fed chair for a possible second term.
So I will answer your question, Paul, but I'm not going to have any comment whatsoever on the renomination process at all. I will say, though, that I have briefed administration officials and I've briefed people on Capitol Hill in detail about what we did and why we did it, and seeking their feedback, getting their reaction. But this is part of my job. Congress has oversight over the Fed, and we take that very seriously. So if you're on our one of the two committees that has oversight over us, then I'm in regular contact with you probably. And when something like this comes up, I'm on the phone. I'm offering to meet with you and explain it to you and answer your questions and identify any concerns people might have. That's just part of my job. So I do that. I don't talk about particular conversations, but you can assume I'll always do that, and I certainly did it in this case.
Thank you.
Thank you. Let's go to Hannah Lang at the American Banker.
Hi, I wanted to ask about the supplementary leverage ratio. Is the Fed still planning on seeking comment on ways to permanently adjust that? And how concerned are you ultimately about banks' willingness to intermediate in the Treasury markets without a permanent fix?
So I don't have anything for you on supplemental leverage ratio right now. We are looking at ways to, if there are ways we can address liquidity issues through that channel. We also have there's a working group headed by Treasury about over Treasury markets and what happened in the acute phase of the pandemic and what structural things may need to be done. So that would be part of that.
I want to know who is an idiot to be buying what right now.
That report will be out, but so it's work underway. That's one of the many
people buying the index right now,
with things like central clearing of treasuries, greater central clearing, and many other ideas. It's important that we have a liquid treasury market. It's a huge public benefit that we do, and I think we need to do those things that enable that, while also assuring safety and soundness of our largest financial institutions, who tend to be the main dealers.
Well,
so
remember, price is inelastic, whether it's at all-time highs or not, doesn't matter.
Thank you.
What matters is where the orders are going to come from. I've actually seen some models that suggest that the next month or two we could see a lot of good inflows.
Engage with people on Capitol Hill and in the administration. You talked about what you've done already, but I'm just wondering if you could take a step back and just assess whether or not
there's a really good zero hedge story where they took all of that information from Goldman Sachs. I need to go back and find that and see where we're at.
Independence. And then secondly, do you look back on the whole episode and have
so it was a long time ago.
Individual responsibility in preventing something like this from having happened?
So I think it's too soon to say what the reputational damage is. I think from the very beginning, my reaction was we need to deal with this straightforwardly, transparently, and forcefully, and that's what we're going to do. I mean, it means everything to me that we do whatever it takes to make sure that nothing like this happens again. And I like to think we've made a real good start on that. If you think about it, you cannot execute a trade unless it's pre-cleared. And then you have to say execute. It's not even a trade. Really, there's no trading going on. This is for investment and getting liquidity for life's expenses. But you then have to wait 45 days to actually execute that sale or purchase. So I think it's a pretty good system. We'll always be looking.
Remember, prices are inelastic, which means that price does not really have any reliable impact on future orders. What does have a reliable impact on future orders? How much money people are making that they have to invest, what their expectations of the future are, things like that. And the models that I've seen on that suggest that there's still some room in this bull rally.
System has more than 30,000 employees. Not all of them. Far fewer of them will be covered by this, but the senior officers who will be covered by this.
Now Tesla is a different issue. Tesla is
have to work efficiently. So there's
an options run, and as soon as the options expire, that thing is gonna come back.
This system has been in place for decades, and it was in place when I took over. It was in place for at least the last 3 or 4 chairs, and it was what it was, and it proved to have weaknesses in it. And part of that was that it wasn't uniformly enforced across the system. I'm a big believer in the value of the Federal Reserve System and the reserve banks, but you had 12 different ethics officers at 12 different banks, and you had ethics people here, and compliance wasn't all exactly the same. It was a little bit different and uneven. And also the rules were, we didn't imagine the problems that happened, and they may have actually been, I don't know this, but they may actually have been in compliance with the specifics of our rules. They were clearly not in compliance with the part of our rules that said don't do anything that would create a bad appearance. I mean, that's clear. This was a bad appearance. So Anyway, what can we do? We are where we are. It happened, and we just have to deal with it forthrightly and transparency and own it and step up to this. Meet this moment. I'm totally committed to doing that. And again, if there are better ideas, I'd love to hear them. But I think we have so far made a good start.
When you say you spoke with administration officials, did that include the president?
I'm not going to answer who I spoke to at all. I'm not going to give you any names, so don't take that as a yes or a no. I'm just not going to start down that road.
Okay, thank you. We're going to go to Jeff Cox for the last question.
Yeah, thank you. Chair, I just want to dig a little bit deeper on employment. We've seen what's been called the Great Resignation, with folks leaving their jobs in record numbers. Is there any feeling there that maybe you've been accused of fighting the last war, that perhaps the labor dynamics have changed in the post-COVID environment, and that full employment may not look like what it looked like before?
Yeah, so what's happening
is a good question.
People are leaving their jobs. They're quitting their jobs in all-time high numbers, but in many cases going back into employment and getting higher wages. So a lot of the higher wages you're seeing are for job switchers rather than incumbents. So that's a sign of a really strong labor market, as opposed to people just running off and quitting. There have also been there are a significant number of retirements, and we'll just have to see what that means. So toward the end of the last cycle, which was the longest in our recorded economic history, we did see labor force participation moving up well above what economists estimate was the trend. And part of that was people staying in the labor force older and just not retiring at the rates they were expected to retire. So maybe this was just catch up on that. I am a believer that over time, you won't know how far, you won't know what can happen with labor force participation in advance, and you're just going to have to give it some time, because we saw that over and over again. There are things that we can say, this is where the limit is. Labor force participation is a much more flexible subject for me, and so I do think we need to be humble about what the limits are of labor force participation. But we expect labor force participation to pick up. We don't know the pace at which it will do so. So in terms of full employment, as I discussed earlier, I think at the very beginning of the recovery.
Oh yeah, or remember, you put $1 into the stock market, it results in $5 to $8 increase in the market cap of the stock market, right?
Expansion in our history. It was so much to like about that labor market. Really, historically good labor market.
When you understand how those numbers are made, it's foolish to sit down and say.
It's just very
the S&P 500 should cap out at X market cap and then fall down, right? The market cap is only useful to compare the relative size of two companies.
Wages didn't really go down, and real incomes were more than fully replaced by fiscal policy. All of this is completely unusual. An economy where inflation was driven by services is now inflation where all the inflation is in goods, which have had negative inflation for a quarter century. So you ask about full employment, I think we have to, I'm very open to the thought that it's going to be an empirical question of where it is located, and we're just going to learn more and more. I mean, one thing we'll learn, I hope we'll learn in the near term, is once the Delta variant really does continue to decline, what's going to happen to employment? Are we going to start to see over the winter significant increases in jobs again? If you look back, the 3, 6, and 9-month average job creation is between 550,000 and 600,000. So if you think of that as a stronger, you don't have to think back to the million job months of June and July. You can just think, okay, 550 to 600. If we should get back on that path, then we would be making good progress. And we'd like to see
the gamma variant,
we'll know
right?
So much more, and
the thing in Tesla really is quite silly right now, right? But I don't think anybody can stop it until the options expire.
Thank you, Mr. Chair, and thank you all for joining us today.
Oh, I gotta mute it before they turn the happy music on again. You think it's going up just because of Tesla? Well, I think that some of the small caps have kind of been beaten up a little bit this year and are getting a little reprieve here, is one of the things. Because like in my portfolio, Goldman has been doing really well, but almost everything else has been poor. And the Zillow thing, I don't know what I'm kind of at my wit's end right now what to do about it. I'm like tempted to just bail on it, but I feel like that the company was good before they doing all of the home purchasing thing, and they're just getting rid of the home purchasing thing. They'll go back to just being a regular company, and maybe they'll try again in the future, or they'll find other ways to take advantage of that data, like selling it to other people or something, right? But they just keep getting now it is you're the redheaded stepchild, right? Now it's the one that everybody on the market wants to beat up on. So does it really make sense to be in it? Well, if Cathie Wood is buying, but when I go and I look at the chart, it kind of looks like Cathie Wood probably already got in. Well, I mean, we know that she already got in, but like I can't clearly see a large meta order buying in there, right? So maybe she bought, but it didn't really cancel out all of the people selling, and it was widely held. I don't know, guys. I don't think that it changes my longer term calculus. I think that it limits the upside, but I don't think it changes my longer term calculus. But it sure feels bad to be in it, right? Could have put that somewhere else much more effectively. Okay, well, let's sort out where we are now after Powell is done talking and see if we can suss anything out. So the treasuries, they are largely a little bit lower than they were when the news first came out. The 30-year is significantly lower, and so there was a very wide degree of steepening, which remember, at the current time, whether it's steepening or flattening has more to do with how much the market believes that we are going to get a reflationary narrative. So when it's flattening, what they're saying is, well, yeah, they're going to increase rates in the short term, but in the long term, it's not going to work out for you, and the longer run rates won't rise because of that. But for now, they're saying that, yeah, you're going to get that reflation. S&P 500 moved up a good lots of points, 40 points or so. So it looks good. I can see that gold has, gold got hammered today, but gold it's come back a little bit and they're doing okay. Oil got hit here just before Powell spoke and just kind of continued down through that. And Bitcoin is now a little bit higher. So Bitcoin had some volatility around it, but then they just bought the dip, I guess. I think that what is going on with monetary policy right now, this is where it gets really crazy, is what's going on with monetary policy right now is bearish for cryptocurrencies, but they ignore it. It was like when it was bullish for cryptocurrencies, they go ham, and then when it goes the other way, they stop the correlation, which tells you what, that they'll buy it no matter what. And that you just got to be worried about when they run out of money. Who be calling me? Ain't nobody I'm going to be picking up the phone for. Okay. Hey guys, I guess it's time for me to get back to work. And it was a good trade. Oh, I guess we should review that too, right? Got 1, 2, 3, 4, 5 positive trades in a row in the treasury. That one doesn't count. That one I didn't have this, was the one tick stop and immediately stopped out. It's fine. That one was probably happened because the volume that was out there was less than, like, basically it's set a volume stop when it shouldn't be, right? So that one doesn't count. And that one does count, but I didn't feel it was very fair. Okay. Because I had it right and they stopped me out. Man. Oh man, somebody's showing a heat map of the S&P 500 and it really is like, wow. Like, it really sucks. You have a really good day like that in the S&P 500 and you own like the one stock that didn't go. Oh, I'm so dumb. Oh, guys. Okay, hey. I will see you tomorrow in the meantime. Stay profitable, friends.